Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thank you for making time on this Friday.
Good afternoon.
Well, looking back this year, it's been a rough one for almost every stock market in the world, with the war in Ukraine, fast rising interest rates, and so on. Korea's biggest companies saw their share prices decline a lot, notably companies like Samsung Electronics, Naver, Hyundai Motor, and so on. In fact, the local market's been one of the worst performing of all of them. What would you say about this past year in the global equity markets?
Yes, I must say that year 2022 was the worst year in history. If you look at the past 100 years of history, 60-40 portfolio, where 60% equity, 40% bonds, performance had been one of the worst out of the 100 years of history. Year to date, that portfolio was down by more than 30%. Clearly, both sides of the equity and bond dropping by two-digit number was unprecedented. So if we look at this as the year, it has been very difficult to sustain in terms of the returns, and also was the toughest year. If you look at the events that led to this kind of result, number one was the much higher rate hike than expected. About a year ago, Fed was not really thinking about raising interest rate that much. While if you look at the past 1 year period, Fed raised interest rate by 4.25 percentage points, which is one of the fastest speeds since the stagflation era of 1960s and 1970s. Also, we had a Russia-Ukraine war, which was not anticipated, resulting into much higher energy prices and also big economic pressure to European economy. And also the third factor was the China COVID zero policy, which led to shutting down of various plants as well as the domestic demand of China, resulting into much weaker growth rate of China that affected negatively to global market. All that resulted into one of the worst year ever in history for equity market, for Korea as well as global economy. However, though, going into next year, there are some factors that we have some hopes for. But in any case, we must say that this year has been one of the toughest years.
Right, and you point out the 60-40 portfolio. People's heads are spinning right now how that worked out this year. And so much of what happens, as we see in the stock market and with bonds right now, depends on policy at the Federal Reserve. And the Fed seems to have more work to do to bring down inflation. So where do you see the Fed going with interest rates in the new year?
Yes, this will be one of the biggest and most important factors. As I said, last 1 year, interest rate been raised by 4.25 percentage point, which is the fastest speed where we did not anticipate it. However, though, even assuming the worst case scenario, the overall interest rate hike over the next 12 months is not going to be more than 1 percentage point. Most likely that rate might go up to as high as 5 to 5.25%. That is average estimation. And also it might go down towards the end of the second half of this year, second half of next year, 2023. The reason for that is because if we look at the inflationary pressure, the money supply growth rate of M2 has been going down rapidly, which will result into inflation pressure coming down as well rapidly. If we assume that, most likely by the end of next year, inflation pressure will go down to below 3%. If so, then the Fed's rate hike above 5% is too much, and most likely that will come down. If we look at the Fed watch, expected interest rate environment by Fed in February of next year is about 4.5 to 4.75%. That's 0.25% rate hike, which is much slower pace of the rate hike than what we saw of giant step and the big step of 0.75 and 0.5% rate hike. And by probably towards the end of the first half, the rate might reach above 5%. But the rate hike per meeting will be only 0.25%. And thereafter, most likely by end of next year, the Fed Watch is expecting the rate will be somewhere between 4.25 to 4.75%, which means that no additional rate hike is expected, which means that rate might rise in the first half, but in the second half, it might go down. So overall, we think that the inflationary pressure, the Fed's interest rate environment is not going to be necessarily negative for the equity market, at least in 2023.
Right, and finally, Mr. Yu, the Korean government sees the local economy growing next year by just 1.6%, which is the lowest it's ever forecast, actually. And inflation, we're looking at 3.4%. And to try and prop up the economy, the government's front-loading 65% of its spending in the first half of the year. What do you see happening with the Korean economy in the new year?
Yes, if we look at the various think tanks' thoughts, most likely, economy is expected to slow down quite rapidly. Various estimation is somewhere between 1.4 to 1.6% growth in 2023 because of the slumping export and also sluggish domestic demand. If you look at the economy as a whole, most likely the first half will be higher, and then the second half is expected to go down even further. However, though, if we think about the implication of the energy prices and also the global economy where Korean government also is expected to put more efforts to use the fiscal budget to boost the economy. And if you look at China is expected to raise boosting measures to increase the GDP growth rate in 2023. If we think about all that, the current prediction of 1.4 to 1.6% growth rate of GDP is too low, we think. Most likely the first half of 1.6% might be sustained in the second half. If that's the case, then most likely the numbers might be coming in better than expected. Also, if we look at the Korean won movement, it has appreciated to about 1270 territories. It did go up to as high as 1440, resulting into much higher inflationary pressure, and government's interest rate hike was much tighter because of that kind of implications. But going into the future, if the global interest rate stabilizes, and also the Korea's interest rate stabilizes, then Korean won appreciation would continue. That would have a positive implication for overall domestic demand and global Korea's economic growth rate relative to global economic growth rate. So maybe we could have some more hope in the second half of next year, rather than assuming the economy might slow down and face the economic recession.
All right, Mr. Yu, we'll have to wrap our coverage of the market for 2022, and we appreciate your contributions to the program every week. Thank you for that, and Happy New Year.
Thank you very much. Happy New Year.